Hey, what's going on, everyone? Welcome, Agents for Life. This is podcast number 217. And I am super excited today because I'm going to share a case study with you. We all love case studies, right? Have a seat, sit back, and enjoy this. This is a debt-free for life case study. So you've heard about us talking debt elimination, right? Debt elimination. Everybody, well, I shouldn't say everybody, but a lot of people are doing it wrong. They're trying to pay off their debts. They go and they pay extra to their mortgage. They pay extra to the credit card company. They pay extra to their student loans. And all they're doing is giving away the interest that they could be accumulating themselves. Okay. These programs, all we're doing is rerouting budgets. A lot of times we don't even change the budget. We just reroute dollars and we just change them so that they go back to yourself first before going out to pay your debts. Now let me show you this case study, and I'm going to tell you why this is the case study that that I really wanted to feature because it's different than most. I've sat through many of these. I refer a couple of these a week. Okay. And there were two, in fact, my two policies so far that I've written this week are both debt-free for life cases. Okay, so if you're not referring and you're an agent on my team, we need to be doing that. And if you're not sure how or you're uncomfortable with the script, raise your hand and let me help you. Because there's a lot of money being left on the table by simply not bringing this up. There's a lot of people that need this. And it seems like, I don't know, but I keep bringing this up and people just keep going, oh, well, that's pretty cool. Where's that been? Right? So this is what it looks like. And this is a debt-free for life plan. I'm going to walk you through it just briefly, not all the pages, so don't be scared. But if you're listening to this on the audio podcast, you might want to click the YouTube link so you can watch the video with all the numbers, because this is in both formats, audio and video. So this, and I blocked off the names. We have the names here, but this couple just met with this week. They just signed up for this program, and they'd be crazy not to after you see what I'm about to show you. But let me show you what they have. They have an Amazon card, $257. They have Menards. I don't even know what that is. Apparently a department store. They have a Lowe's. They have a Care card, Capital One. They have a Van, Subaru. Okay, so a bunch of debts. Okay, and this isn't absurd. This is a typical American family with some credit cards. You can see some student loans on here, a couple of cars, and a mortgage. Okay, American dream, right? Go out and get a bunch of debt and do the best you can and then try and pay it off. And you spend a lot of time trying to pay it off the old-fashioned way. Well, this program is changing lives, absolutely, because watch this. We went through and we totaled up all their balances. Okay, so you can see how much they owe. You can see the average interest rate on what they owe. Some of these credit cards, look at that, 28, 29%. Crazy high interest rates, right? Well, their monthly payments right here, how much they're paying in debt. So this family, they make good money because they're paying out just on their debts $5,671 a month. Okay, minimum payments. These are the minimums. And then monthly interest, okay, and in terms of dollars. And then over here, you have something that a lot of people haven't heard of, and it's called the effective interest cost. This is where the problem is. Okay, the problem isn't $335,000 of debt. The problem is 45.2% effective interest cost. Okay, what this means is every time they send a dollar bill out their front door toward a creditor, toward the credit card company, to the mortgage company, every time they're sending a dollar bill out the door, 45 cents of that dollar bill is just going to satisfy the interest. Doesn't go to payment or principal. It doesn't bring down what they owe. It just satisfies the costs of them borrowing that money. Who gets the 45%? All that money they're paying out? The creditors, the banks, right? Credit card companies. Right? The banks, these guys have the tallest buildings downtown. They got the nicest furniture, the fanciest executives, the most highly paid employees. Guess why? They make a lot of money off charging interest on loans. And we are happy to pay it because we don't know any better until this, right? Until you start understanding and wrapping your mind around a different way of banking. And that's what this is. This is built on, if you might have seen on the internet or something, the infinite banking concept. Okay. or privatized banking. Okay, that's what this is built off of. It is not an average whole life policy. An average regular run-of-the-mill whole life policy does not work for this. Okay, it has to be done by a mutual company, and it has to include a paid up additions rider. I'm not going to explain all those details right now, but if you structure your whole life policy well, you get the benefit of tax-free growth, compound interest, okay, and uninterrupted growth. So what that means is if I borrow money out of my policy, against my policy is the right way of saying it. If I borrow money against my policy, it doesn't reduce my principal. My policy continues to grow as if I had never borrowed that money. Okay, does that make sense? So that's what we've got all those things going on here for these guys. So let's take a look at this. Look, we're going to jump in here. $200 a month. So these guys say, okay, we want to put in $200 a month toward our debt-free plan, because you got to start somewhere, and that's where they decided to start. Perfect. This is what is their current plan. They have $335,000 of loan. When they're done paying it, if they just do the regular plan and pay the minimums and do their current plan, they're going to be paying $159,000 of interest. Guys, that's another house in some states, in some neighborhoods. $159,000. It's a really nice car, right? I don't know. You might be able to get a Lambo for that thing, but for that amount. But I'm just telling you, $494,000 total they're going to pay. And we all know this. When we buy a mortgage, there's a truth in lending statement, right? And we all get to see it. And we have to sign it. We know, yeah, I'm buying a mortgage for $300,000 and I'm actually paying $450,000. But, you know, that's 30 years down the road. Who cares? Sign on the dotted line. I'm excited to move in. Woohoo, right? Well, guess what? When you put this plan to work, guess what happens? Now watch this. Watch these timelines. All right, same debts, right? You've got the Amazon credit card. Okay, we're going to start with $200 a month. Now let's go through this, and I'm going to explain to you what's happening so you can see the power of what starting with $200 will do in the end. Because starting at $200, they are, first of all, tackling this initial debt of which has $32 of interest, or $32 a month of interest. They're going to knock that out in 9 months. Or I'm sorry, yeah, the traditional way, 9 months. Doing it this way, it's 4 months. So they're going to cut the first one in half. 21 months versus 12, 29 months versus 26, 110 months versus 30. Crazy. 59 months versus 33, all the way down. Look at this one, 260 months it would have taken them to knock out that huge student loan, 47. 331 months on the mortgage, down to 72. Instead of August of 2051 being debt-free, these guys are going to be debt-free January of 2030 based on guarantees. This is not speculation. This is math. Some people say, well, how is this even possible? Well, it's just math. And you can see the math, and I can go down. I'm not going to show you here details, but this is inside the policy, how it works. But it's guarantees, and it's based on guarantees, and it's based on math. But let's go back up here. And let's understand this just a little bit better, how this is going, because it grows in a snowball fashion. So we're going to pay off the smallest debts first, and you can see how they're all lined up. And we're going to take this $200. This is where they're going to start, okay? And right there, boom, they wanted $200. So we're going to go and we're going to tackle this first debt at $200 a month. In 4 months, I think it said there's going to be enough cash value to pull money out and knock off the $257. Well, that $33 a month they were paying, we're going to add that to the $200, and we're going to keep contributing. So now we have $233 a month going in. And then in 12 months, we get to knock out the $2235. Boom, gone. We have enough cash, we pull it out, we knock it out. Now that $115 we were putting in there, guess where that goes? Plus $115. Now we're contributing $348 to our debt elimination plan. Boom, next one. And we go down the line, 120 plus 173 plus 400 plus 678, right? $1,371 a month going into their debt plan. You see how they're starting to turn the tables around. Instead of giving this all to the banks, they're giving this to themselves. They're capturing the compound interest, growing a cash asset that's going to continue to grow the rest of their lives By the way, keeping them out of debt, because this is debt-free for life, not for a year or two. This is debt-free for life. So go all the way down. Guess what? By the end of this, they are now putting in a whopping $5,600 a month because they're knocking out their debts and they're just taking what they were already paying to each of those debts and putting it in and feeding the fire, which starts out kind of small and grows and grows and grows until the end when it's this blazing bonfire. So by the time they're done, you can see they save 21.58 years off of their debt plan. 21 years faster. Here's a timeline of all the debts and when everything gets knocked out. And guys, if you'll see, take a look at this, they will have saved 85,000 in interest, but even more importantly, by the time they're done, in the seventh year, by the end of the policy year 7, you'll see that down here, they will have accumulated a net cash value of $15,000. That, by the way, will continue to grow the rest of their life. And that's illustrated here as well. So once they're debt free, that now continues. And you can see they don't have to keep contributing. They can back out and they say, I'm done. I want that $5,600 a month I've been paying in. I'm done. We're going to go use that and have some fun. But guess what? Meanwhile, this cash asset continues to grow because they have fed that for 7 years. And now you've got growth and momentum and compound interest on your side. Death benefit included, living benefits, didn't even talk about that, chronic, critical, terminal illness coverage. So you don't find these plans anywhere on the market except inside of a life insurance policy. This one worked particularly well because they had several debts close to each other in sequence so that that snowball effect really, really takes hold here. But I'm excited about this because there are people everywhere that are taught just make extra payments on your mortgage, you'll get it off faster, or go make extra payments on your credit card. That's all we're taught to do. We don't know about life insurance being designed specifically for high cash value accumulation with paid up additions rider. Did you go to school and learn about that? I didn't, right? I've been a life insurance agent for 5 years and I didn't start learning about this stuff when I first got my license. I didn't know about this stuff. So the average person just doesn't hear about this. But this case and many, many, many more just like it show the power of those three concepts coming together: compound interest, uninterrupted growth, and tax-free. Isn't it beautiful that you're not in bed or partners with Uncle Sam? This is tax-free growth. Who loves paying taxes? Raise your hand. Yeah, I didn't think so. So anyways, I love this. If you're not already in this, doing this, then I encourage you to jump in and start writing these policies and referring these policies for people. It's a very powerful concept. If you're listening and you're not an agent and you have some debt and you want to sit down and chat more about this because you're intrigued by what it can do for you possibly, well, get in touch with me. Wherever this is, click on the link or something, shoot me a message, get in touch with me, and I'll be happy to walk you through specific numbers for your case. But thank you for listening. Go out there and make sure that you're eliminating debt. Debt does have a hold on us. It's debilitating. It makes us feel less about ourselves. Nobody likes debt. Let's get rid of it. Let's knock it out. And this is an awesome way to do it. So thank you for listening and have an awesome week. Bye.